Hey, welcome everybody. Today's webinar is being hosted by Journey Energy. It is one of the upstream oil and gas companies in our small cap growth portfolio. It currently trades on the TSX exchange with the symbol JOY and on the US OTCQX with the symbol JRNGF. I believe the current share price is significantly below the PB10 net asset value based on their recently updated December 2024 reserve report and the current balance sheet as of March 31st. Joining me today is Alex Verga, the company's president and CEO. Journey Energy was founded in 2007 and is headquarters in Calgary. It is involved in the exploration, development, and production of crude oil, natural gas, and NGLs in Alberta. The company reported first quarter 2025 production of slightly under 11,000 BOE per day with a mix of 48.5% crude oil, 40.7% natural gas, and 10.8% NGLs. Natural gas prices are finally rising in Western Canada, which should give Journey a nice revenue boost in the second half of this year. 2025 is going to be a big year for the small cap, and I believe there's some near-term catalysts that should draw more attention to the stock and then get people to discover why I believe it's so undervalued. The company is in a large joint venture with Spartan Delta, which is another company in our small cap growth portfolio that I'm very familiar with, that has the potential to be a transformational project for Journey. The JV covers 126 sections of land in the core oil-prone area of the Duvernay West Shale Basin play. The JV split is 70% Spartan Delta and 30% Journey. Spartan Delta is the operator, but from per share standpoint, it actually has more leverage potential upside for Journey, I think. They drilled 5 gross horizontal wells that were completed in 2025, and all are producing at or above the type curves. They've got 8 gross horizontal wells in this year's 2025 drilling program, and 3 have been completed in May that have not yet been, that should be announced here shortly. Journey also has an expanding polymer flood at Medicine Hat, that should increase production and add a significant amount of proved reserves, and they have a growing power business. Today's speaker is Alex Verga, and Journey Energy's president and CEO. He has more than 40 years experience in the oil and gas industry. He has served as director, CEO, and president of New Vista Energy Limited, is a member of the Association of Professional Engineers and Geoscientists of Alberta. He received a bachelor's degree of science degree in chemical engineering from the University of Toronto and a master's of engineering degree in chemical and petroleum engineering from the University of Calgary. During the webinar, if you have any questions, please type them into the chat box and I will read them at the end of the presentation. We'll answer them then. With that, I will now turn it over to Alex for an update on Journey Energy's outlook for 2025.
Thank you so much, Dan. And thank you to the Energy Prospectus Group for putting us in our small cap portfolio and also for hosting these kind of webinars that give companies like ours a voice. It's a really important service and you guys do a tremendous job. So thank you for that. I am delighted to talk to you today, this Friday morning, to go through our new corporate presentation. We uploaded a new corporate presentation on in May of this year, and for us, it's really a departure in our company. I guess our company's gone through a lot of phases, kind of a pre-2020 phase and a 2020 to 2023 phase, which would be like Journey 2.0, which would be, kind of growing our business and repairing our balance sheet coming out of that COVID period. And now this is kind of like the Journey 3.0 phase where we're moving forward. So we've changed the theme of our presentation. The new theme of our presentation is unconventional. And you can see here on the title page of the presentation that what we're showing here is actually pictures of the core of the Duvernay. And, unconventional, it refers to our Duvernay resource play. We have conventional reservoirs and we have an unconventional Duvernay shale play. So it refers to the Duvernay resource play, but it also means different. And I think what you're going to see as we go through this presentation is that as a micro cap, I mean, we have things inside Journey that other micro caps don't have, and that makes us different. And so, first of all, for a company that has such a small enterprise value, we have a world-class Duvernay shale resource play. And it is extremely significant to a company of our size. We also have an emerging power business. We have an expanding polymer flood in our Medicine Hat field. And, we have a very large base of predictable production, stable, low decline sub 13%, which basically contributes to the undervalued nature of the company. We have a snapshot in the presentation kind of showing some of the summary parameters. I'm not going to go through all of it. I do want to draw your attention to the fact that there has been $1.5 million worth of insider purchases since Q4 of 2024, and most of them have probably come since March, since we came out of blackout, on the 24th of March. And myself, if you go through the information circular, we just went through our AGM. Our information circular came out May 22nd, 2025. You go through that information circular, you compare it to last year, you can see that I've gone up from 4.2 million shares to 4.725, so I added 525,000 shares. And then Craig Hansen, our chairman, his holdings have gone from 240,000 shares to 810,000 shares. That means he's added 570,000 shares. So that's about 1.1 million shares added between the chairman and the CEO, since the previous AGM. So, if you believe in those things, I mean, we're putting our money where our mouth is, and we know what we're sitting on, and we both of us have been in this business a long time, and we know value when we see it. So we have a chart just showing kind of Journey at a glance, showing you where our power generation projects are. We'll talk a little bit about them, where our Medicine Hat property is, and then where our Gilby Duvernay joint venture is, and we'll be spending more time on that. So just on the high level, I know that Dan alluded to the undervalued nature of the company. We do have our business plan over the last few years here. We have the first quarter in there. We did have some guidance out there in January of the year. It was based on $72 WTI, but of course, Liberation Day happened on the 1st of April, and we're experiencing a lot of uncertainty and where the price of oil is, where it's going over the course of the next year. So we didn't really add a lot to our guidance, but we did basically put a table in here showing you, versus the AECO gas price and versus the price of WTI oil, where the cash flow is going to be for the year. Now, our capital budget is largely fixed at about $50 to $55 million this year. Most of that budget, almost all of it, will be spent by July of this year. There'll be a few more power costs coming in the fall of the year, but we're going to spend over $30 million on the Duvernay in the first 6 months of the year. Like I say, most of that should be spent by July 1st, and I will talk about what we're doing and what these near-term catalysts are for these Duvernay wells to come on in a few slides from now. So I'd say there's maybe an upward bias to that cash flow, largely because operating costs are coming in a little bit lower. In general, for us, we usually spend somewhere in the neighborhood of $12 to $15 million a year repair and maintenance costs. And when prices go down, we don't put as much stuff on. So operating costs can be a little bit lower in years when prices are lower. So if this is what we would call a lower priced year, then we probably might have a little bit of a benefit, slightly lower operating costs. And here's the value proposition. You can see where we were in 2020, and you can see where we are now. You can see the value that we've added. Obviously, prices kind of peaked in 2022. You can see that in the business plan slide, and have deteriorated in 2023 and 2024. Offsetting that is a little bit of growth in our 2P wedge, primarily because of future bookings in the Duvernay. So when we look at the base value of the company at the three consultants average pricing, our PDP value per share at the end of 2024, based on the new reserve report, was $4.33 a share. That's based on about 37 million barrels of total reserves, of PDP reserves, but about 17 million barrels of oil reserves. Now, we see a roadmap from 17 million barrels growing to as much as 70 million barrels. First of all, there's 5 million barrels of probable producing reserves, which just means if you just soften the decline on your existing asset base, your produce out reserves go up from 17 to 22 million barrels. So that's 5 million barrels right there. We have a 15 million barrel probable wedge. That wedge is all in our, that's excluding the Duvernay. It's all in our conventional oil pools. It'll be something like drilling in Medicine Hat, drilling in Skiff, drilling in West Rose, drilling Belly River, like a whole bunch of stuff, but 75% of it is associated with about 5 properties. So you don't need to get your head around a ton of properties. There's a big upside in 5 of our larger pools. And from there, that brings you to about 35 million barrels, doubles your reserves. From there, we have the potential to double our reserves again in 2 properties. One is the expansion of the Polar and Medicine Hat, and the other one is our Duvernay drilling. And all of those are primarily unbooked. So a tremendous amount of upside and a roadmap to growth. And I'm going to explain in this slide. To me, this is a fairly important slide. It is fairly confusing. So I'll try and explain it to the best possible way I can. But we get constant discussion from shareholders saying we are so undervalued and we are way undervalued with respect to all of the other companies. And what they're primarily referring to is the chart in the bottom right-hand corner, which basically shows you that we are trading at a very significant discount to our proven producing net asset value. And that's what Dan alluded to. But when you actually look at where we're trading on a multiple of cash flow or a multiple of operating income, we're not that far off. So the chart in the top left shows where our operating income multiple is relative to the industry. The industry's at about 3.4 and we're at about 2.9 times. And so you're looking at it going, okay, so on a multiple of cash flow, they're trading okay, but on a multiple of NAV, they're trading terribly. And how do you rationalize all that? And the way you rationalize that is just by saying, look, we have a really long reserve life index relative to other companies. So we have a very, very stable, very, very flat cash flow stream in our reserve report. So our reserve life index is 8.9 years. You can see that on the chart in the bottom left. You can see how long that is. Now, what that means is that our net asset value is a high multiple of our operating income because the reserves are so flat and so stable. So the advantage of that is you've got a lot of barrels under management. If you look at the chart on the top right-hand side of that, you can see that we're trading at or near the top on our multiple, our net asset value as a multiple of our operating income. We're near the top of that chart. And so if you look at us compared to some other companies, you may have a company that's on the other end of that chart that's got a very low operating income multiple to PDP value because they have a 34% decline and their assets are all ramped up. They're also going to have a very short RLI. And if they're trading at the same multiple of operating income that we are, they're going to be trading at a higher cash flow. So here's the way we see it. Journey is very long on net asset value, and we're very short on operating income. So the solution to that is to ramp up your operating income by focusing your capital on rapid return, high netback drilling like the Duvernay. And this is why the Duvernay is exactly what the company needs at this time. In 2022, we did a deal with Enerplus where we added some assets to the company. What wound up happening is we wound up adding a low decline, undercapitalized asset base to another one. And then we wound up having some erosion in pricing in 2023 and 2024. We wound up trying to pay down the leverage that we created by adding those asset bases, and we just made the situation more undercapitalized. So now you're going to see our growth capital move to the Duvernay. You're going to see our cash flow and netbacks ramp up, and you're going to see support for all of that value that you see in our net asset value. So this is why the Duvernay is so important. And the other reason the Duvernay is so important is because I think it competes with almost any other play in North America. I'll just jump ahead one slide and then I'll jump back to this slide just because I want to show you this map where it orients the pools. And so on the left-hand side, you can see the chart. You can see the pink color down in the south. That's Paramount. You can see all their new wells there in purple. You can see in the khaki color in the north east, Baytex's land. They're drilling north-south. You can see all of their wells there. You can see in the gray lands, those are Spartan Delta lands. And Spartan Delta also has 70% of the Journey joint venture, and that is the lands that are in the orange there. In our view, if you want to be close to the reef trend, which is that purple trend in the sort of southeast part of that map sheet. You want to be close to that reef trend, but parallel to it. And the further you get away from that reef trend, the more gassy you get. So we are right in the heart of the oil window and the most liquid rich window part of this trend. So, when it comes to neighborhoods, we're in the best neighborhood. And so here's what we've been doing in over the last few months. There are 3 solid lines on that chart that don't have numbers on them. Those are the original 3 legacy wells drilled in they came on in 2019. They were drilled by Cuitno. Cuitno put about 130 to 140,000 cubic meters of water in each of those, along with about 6,500 tons of sand. Those wells were great wells. I would almost call them basin leading wells, but they use limited entry fracs. They probably got a lot of height growth. The Duvernay itself is very thick. It's 40 meters thick, but they may have got more than 40 meters of height growth. So the reality is that a lot of that sand and a lot of that completion energy might have gone outside of the reservoir. In the wells that we've been drilling with Spartan Delta, we have been using more clusters per stage, more perfs per cluster, and essentially focusing on getting the same amount of sand in with a lot less water and getting a little bit less height growth and leaving most of that frac completion energy in the reservoir. So that's probably why the performance has been better. So the wells 1 and 2 there were the first 2 wells that we drilled. We drilled them last fall. We brought them on at the very end of November, beginning of December last year. Both of those wells have paid out over 60% of their capital already. They've both produced well over 100,000 barrels already. They were much better than the original 3 wells, and we'll talk about that. And so that's basically, those are on production, those are in Petronix, those have been press released, those have been discussed. And as part of this year's program, we're drilling 8 wells and we're completing 7. There's 1 well in the very north end of the map sheet, in the central northern part of that map sheet, that is just north of the number 3. That well will sit as a duck and we'll complete that next year. But where the 3 is on that map sheet, we've drilled 3 wells. And those 3 wells all have the 2 wells, the 1 and 2 that we originally drilled, had about 3,500 meters of lateral length, 3,500 to 3,600 meters of lateral length. The new wells have 3,900 meters of lateral length, so they'll have maybe 5 more fracs in them. So off of pad 3, we have drilled 3 wells. They have all been completed. 2 of them came on about 2 weeks ago, and one of them should be coming on this weekend. So sometime within the next 30 to 45 days, you're going to start to see some results on those wells, and you'll see how they compare to the wells 1 and 2 that were drilled. And then we also have drilled all of the wells at the pad 4. There's 4 wells that were drilled there. Those wells are about a month behind. The completion rig moved on there about a week and a bit ago. We're on frac kind of 15 to 17 for each of those 4 wells. So those wells should all be completed by the end of June, and they should start coming on in July and August. So here's what you have. You have 2 wells that are on middle of May, 3 wells on by June, call it 4 to 5 wells on by July, and all 7 wells on by August. So sometime over the next 3 to 6 months, you're going to have all of the data that you need to evaluate this play moving forward and see the overall impact on Journey. Now, last year in December, we announced that we had increased the type curve. You can see on the chart here on chart 12 that type curve is a little bit higher than the average of those 3 wells. So the 3 wells that are shown in gray, those are the wells that were the original legacy wells, and we had a type curve that basically bisected those 3 wells in the middle. We increased this type curve by more than 10% on the oil side, and did that based on some initial results from these first 2 wells. You can see these first 2 wells are outperforming that type curve quite significantly. I think that type curve might represent a very good type curve as the average for the play. I think some wells, you're going to have parent wells and child wells. I think the child wells might do a little worse than the parent wells. The unbounded, let's call them bounded and unbounded wells. The unbounded wells should do better than the bounded wells, and those 2 new ones are unbounded. But you can actually see that they are doing significantly better than the type curve. So when we start to show some new wells, it'll be interesting to see how much better they are. Are they tracking these new wells, or are they tracking a little bit worse? And we're going to be excited to talk about these as the results are available. And we are in full belief that this play is going to be everything that we say it is and more. What we did is we just said, okay, well, and I know that our partner Spartan had also done this for their own acreage. We've done this for the joint venture. We said, what would happen if we take that type curve and we apply it, multiple times to drilling, and what's the shape of that curve going to look like? So we've got 7 gross wells, 2.1 net wells. Remember, we're 30% of this entire block. 2.1 net wells in 2025. And they're all going to be on by summertime. So you can see that peak in 2025. And then we've got, 12 gross that we assume for next year. I mean, that could be as much as 16. We don't really have Spartan's firm plans for next year, but, we're initially budgeting 12. And then we've gone up to 16 wells every year thereafter till, the end of 2030. So thing about this type curve, or this production forecast, is there's only 85 wells in here. There's 200 to drill. So 200 gross, 60 net. This is 85 of the 200 gross wells in this forecast, and this is a Journey net forecast up to 8,000 barrels a day. So if you look at peaking at 8,000 barrels a day with a 47.50 net back, that's somewhere in the neighborhood of 140 million of cash flow that you can add from a standing start with this play. And when you look at how much capital is going to be added to do this, I think you're going to find out that if you look at the numbers by the end of 2030, we probably haven't added any capital. We've probably taken as much capital out as we've added. So it's, it'll become self-funding in 2027, and then you'll start paying back all of the initial capital over the next few years. And by the end of 2030, you've probably got no net money invested in this, and you've got 140 million of incremental cash flow. So this is where we're heading. And, I know that there's a million assumptions in these things, and, really the proof is in the pudding. But over time, we think the more visibility that comes onto this play, it'll be impossible to ignore this in Journey's story that's already undervalued. I'll spend a little bit of time. I mean, clearly the Duvernay is the big story for us moving forward, but you know, here's a piece of business that we have in the company that is not really in the stock and not really in the valuation. We built a power plant, small one in Countess in 2020, brought it on. It has already paid for itself. The one thing to highlight here is that power prices in Alberta have deteriorated quite a bit since 2022. I'll talk about that in the next slide. So our Countess plant only ran 38% of the time in 2024. I'll talk a little bit about that. I mean, it realized the price of $115 a megawatt hour, but when the average price was $62 or $63 a megawatt hour, but that's because it only ran for about 38% of the time. So we'll talk about this and the power business and in the next slide. But we're building the Gilby Power Project. The initial start date for that is scheduled for October of this year. Is it going to make that? If it doesn't make it, it won't be our fault. It'll be, again, regulatory, and that's what continues to push these things. The original ISD date was January 2024, and it's been the regulatory process and the regulators that have pushed these things out to their current dates. Same thing with Mazeppa. This is a project that produced power before we bought it as a sort of self-contained project. We have now worked with ATCO to redo their meter station, brought the gas to the lease. We're getting ready to basically turn these engines over and see how they do. That'll probably happen sometime this summer or fall. And the ISD date for this being connected back to the grid is in June of 2026. So in terms of the power business, remember, most of this money now has already been spent. So over the last few years, we've invested more than 30 million in this business. We think, last year we thought it would be worth $90 million. I'm not sure what we think it'll be worth this year. It's obviously could be worth a little bit less than that, but that value is going to fluctuate with power prices. And power prices are going to move up with supply and demand. And as we get more renewables in this province, I think we're going to see more volatility. But in this chart, you can see in the bottom left-hand corner, the Alberta power prices, since going back to 2000, they've averaged about $68 to $70 a megawatt hour. You can see the peak in 2022, and you can see the fall here in 2024. And power prices have also been low in 2025. We do have, in the short term, a temporary surplus of power in the province. We know that over time that's going to change pretty dramatically. We also know that most of the big players in the province need this $68 to $70 a megawatt hour historical average to actually break even. So we do think that things are going to come offline. Things aren't going to come online until we get back to that historical average. But, are we going to get back to the 2022 highs? I personally think we are, but I don't have a crystal ball that says whether or not we will. So what we've provided here is a matrix with power prices and natural gas prices and our own estimate of what the costs are for the 30 megawatts of power that we're planning on bringing on here over the next year. And, you can determine what you think. Now, I think that this is a very conservative view. We're not necessarily going to run these projects full time. Because these are a little bit larger than 5 megawatts, we can actually work with providers like Eureka to bid the power in a slightly different way. These projects can get paid even though they're not on for parts of the time. So that means less carbon tax. So I think you may be able to get this revenue, but you may be able to get this revenue with less operating costs. So they may be even better than this. But what I will say is the money's been spent. These are 20-year projects. They're going to last for 20 years. Reciprocating engines last for a very long time. They can be turned on and off at will. The gas can be either sold or not bought, or the power can be generated. They will have full grid connections. So I mean, we are going to work with providers here, and we're going to optimize the value of these units. I can't tell you for sure what they're going to be over time, but I think it's a really nice thing to have in our portfolio. And if power prices go back to where they were in 2022, this provides a hedge for our operating costs. So if we go back to 2022, in 2020, our power bill was 3 to 5 million a year. In 2022, it was 23 million. In 2022, 1 month it was 600,000, and in December of 2022 it was over 3 million. So when you have that kind of volatility, and if you forecast that volatility to increase, and you know that fuel and power is your number one operating cost, I think having these things in the portfolio is something really great as a hedge against higher operating costs due to higher power prices and power prices spiking. And so to me, this is a great piece of business, and it's another thing that makes Journey unique, and it's another thing that makes Journey, different than the other microcaps. Another thing that makes us different is this Medicine Hat oil pool. It's a large, over 300 million barrel pool. We've only flooded about 20% of this pool with polymer flooding. We do have about a 30 well infill well drilling wedge inside this pool to complete all of the patterns. It has been extensively drilled and it has been extensively water flooded, but it's a very thick, very high oil in place pool. So when you actually look at the numbers themselves, the PDP value of this pool is about 110 to 120 million dollars. The 2P value of this pool alone, forget the Duvernay, forget the power, is basically the value of our enterprise value right now today. Just the 2P value of the Medicine Hat pool. And the 2P value of the Medicine Hat pool just includes infill drilling. What you can see here in this picture is a picture of our 6 of 16 polymer skid. We have a polymer blending facility in the north and the south of this pool. If you replace them today, your replacement value would be very high, probably close to $60 million. So they were constructed for 30 million back in 2012 and 2015, but they may cost up to 60 million to replace today. So we flooded about 20% of the pool with polymer. We can flood the rest of the pool on a fairly cost-effective basis. This is going to happen over a long period of time, over a 50-year history. If you look at sort of the top part of that arrow, that kind of tells you that that's kind of where the polymer forecast would be as you increase the polymer flood out into the future. So you might be able to hold this thing flat at net to Journey about 1,500 barrels a day for 20 or 30 years by just cost effectively expanding this polymer. And like I say, none of that expansion is booked. And then we also have our conventional assets, low decline. You can see there our Annie Creek field and some of the pictures of our Skiff, Sawtooth, where it is in the southern portion of the province. Our goals over the course of the next few years are going to be to gradually rationalize these assets, reduce our overall ARO, and basically replace this with the expanding high netback, low ARO Duvernay production. But you can see here that even in our conventional resource, we have about 1 billion barrels of oil in place. And, even when all is said and done, we're still going to leave 84% of that oil behind. So as oil prices increase over time, if you're bullish on oil, this becomes a really large future target for us. You can see there how much is really booked in that 17 million barrels. I mean, you've only got 3% of our oil in place that's booked as in that future wedge. We've got a slide here on our drilling inventory. The key aspect here is that at the end of the year last year, we booked about 45 of the 200 gross Duvernay locations. So we've only booked 22% of the Duvernay locations on the 2P wedge. So you can see that the Duvernay has become a bigger and bigger piece of our booked inventory, and you can see how big it is there. But you can also see that on the unbooked side, it's become an even more significant future booking piece as to where it is. And in the lower commodity price environment, you start to think about economics and you start to think about these things. And you can see that the Duvernay economics, as you move from the left to right on that comparative economic versus oil price IRR curve, the Duvernay does suffer, erosion in IRR as you move from, MSW prices of $120 a barrel, which is kind of where we were in January, to lower prices in the $80 to $90 a barrel range. But you can also see that because the decline profile of the Duvernay is so quick, like I say, at the end of March, we had paid 56% of the capital back from those wells that came on in December. So the reality is, because you get this payback so quick, your return suffers a little bit, but your payback and your return of capital is still really great for the Duvernay. It doesn't suffer anywhere near the same erosion as some of the other plays. So this high netback play works in even a lower price environment, and we consider this to be a true world-class play. And so, in conclusion, I mean, these are the ways that we're going to recover our get our multiple expansion back, get our cost of capital back. We're basically going to focus on increasing our funds flow per share. We're long on NAV and we're short on funds flow per share. The Duvernay netbacks are 3 times the average Journey corporate netback. And, that is going to ramp up our cash flow. And then we're going to increase our sustainability by, adding this cash flow from our power to offset our largest operating cost. We've always been focused on increasing our net asset value. The Duvernay and our power business are going to do that. They are not fully booked in our net asset value, and there's hardly anything for those booked in the PDP net asset value, that 433. There's virtually nothing booked in there for those 2 projects. And we're going to reduce our cost structure. The Duvernay is going to help us do that. So I think we have a really bright future ahead of ourselves, and I think we're right in the face of some really great catalysts that people are going to be able to see. So thank you very much for your time. And Dan, I'd like to open it up for questions.
Okay, good presentation. I got a couple of questions. Then we got Harry Van Nex, our petroleum economist that lives in the Netherlands. He's got like 45 years of experience with Shell, and both of us are ancient guys that have been in the industry for a long time. I put up a chart. I spoke at a conference up in Dallas on May the 21st, and I put up a 70-year chart of the oil price. And I've been in the industry for the last 50 years on most of that chart. So I know there's a lot of volatility in the oil price here. But hey, let me ask you first, how much do these Duvernay wells cost to drill and complete?
I'll just quickly whip back to the Duvernay type curve slide. So you can see there in the top part of that slide for the development capital, we've got drill complete equipment tie-in capital of 12.5 million. So what we're working with now, the costs are going to come down year over year. What we're looking at this year is about 4.5 million to drill each of these wells, 7.5 million to complete them, and somewhat in the neighborhood of 700,000 to build the kind of pad facility and tie the wells in. There may be as much as 300,000 to 500,000 to testing in there too. So at the end of the day, this year, the average cost of the wells might be as close to $13 million. Next year, they should be well below 12.5 million. And I think ultimately we'll be able to get them down to around 11 million. Some of the things that we're doing.
Oh, that's single well. Okay, that's single well.
Yeah, 11 million. Yeah, for a single well.
Okay.
I think the way the costs are coming down is, first of all, the first 2 that we drilled, it doesn't make sense to drill these on a 2-well pad. you need to drill them on 3 and 4 well pads because that's going to dramatically reduce your completion costs. So you're not going to be waiting on coil and everything like that. And your water logistics and everything else are going to be going to be lower cost if you have bigger pads.
And
Uh,
there's the infrastructure and pipeline access and everything is good in that area.
Yeah, the infrastructure is excellent. Yeah,
Okay,
it's
good.
there's an excess takeaway of gas processing. We have a gas processing plant where most of these wells are going to that Journey owns and operates.
Yeah. Hey, what are your current AECO gas prices like? What do you think your gas price is going to be in the second quarter? And then also, are your NGL prices were all also pretty good in the first quarter? Are they holding up?
Yeah, I think the NGL price is holding as a ratio of the oil price.
Okay.
So the fact that the oil price went down, the NGL into the second quarter, the NGL price will fall a little bit in proportion, but the ratio doesn't seem to be deteriorating.
Yeah.
As far as the AECO gas price, it's been averaging close to $2 an MCF. This morning I noticed it was a little bit lower. It was like $1.30 on the spot. But it has been averaging close to $2. We produce about 27 million a day of gas, and we've got right now till the end of this year 15 million hedged. We are hedged at about 290 at GJ, so just over $3 an MCF.
Mhm.
So we're hedged at significantly more than what it's currently priced in at, and we're probably hedged 75% of our production net after royalties. So we're really well hedged on gas prices. We don't have much hedged in oil, just puts that are kind of out of the money. And so, we would need oil to drop even further from where it is today to actually make money on those
Yeah.
puts. Let's hope we don't.
Yeah. Our NGL price down here is more tied to the gas price, it seems like. And then that cold winter really depleted our propane reserves are below normal for this time of the year. So refilling that storage also helps. Anyway, what on you got the recoverables? What's okay, you got the IP rates too here. Okay.
Yeah, the IP rates will, yeah, sorry. The IP rates are on that slide, and then on the type curve, you can pretty much see everything. But yeah, everything's on here.
Okay, so we should get by the end of June or something, find out what those first 3 wells are.
Yeah, I mean, in the first 2 wells, I think there was some reluctance to press release after 30 days. And of course, we have to work with our partner.
Mhm.
I guess if we deemed it material, we could release earlier than them, but I think we'll probably go along with them. And the last time they released it was after 60 days.
Okay.
So they waited for a 60-day IP, and that would put us sometime in the middle of June on the first two, sorry, in the middle of July on the first 2 wells, so sometime around Stampede Week. We're all going to put out our second quarters around the beginning of August. So you're gonna see stuff by mid-June probably, and you're gonna see more stuff by mid-August.
Okay. But those 7 wells you're going to complete this year should all be completed by the end of the third quarter.
They will all be completed by the end of the second quarter. They'll all be
Oh,
completed this month. We're on the last 4 wells
okay.
right now. We're on frac 15. We got 75 fracs to do per well, but we're basically completing all 4 of them at the same time. They should be completed by the end of June. So
Okay.
they should be coming on at the beginning of July. Uh, I'm not sure we'll bring all 4 on at the same time. We may bring on 2 and 2. So 2 of them may come on in July and 2 of them may come on in August. And what we're actually doing with that pad is we're actually doing some at slightly lower frac intensity, lower tons per meter, just to see what the impact on tons per meter. So while we're doing this program, we're drilling them in different parts of the Duvernay. We're testing different sand concentrations. But we're only putting about 40,000 to 45,000 cubic meters of water in these fracs versus 130,000 before, and we're still putting in 6,700 tons of sand over 75 fracs.
Amazing the amount of sand.
It's incredible.
Yeah. I've seen these trains full of sand going by sometimes.
Yeah, it's 300. Like
Yeah,
if you looked at a bulker, a frac bulker of sand, it's probably 300
of those.
truckloads of sand per frac, and we're
It's
doing
amazing.
four of them. So
Yeah, it's amazing. Anyway, you did the recovery reserves. And one of the questions I had, so Spartan Delta's history is kind of they buy an area, build it up, and then sell it when they believe, if there would be like a spike in the oil price to 85 or 100 or something, they might sell this whole project. If they would do something like that, does Journey have any kind of like first right of refusal?
no, we don't.
You don't?
No, we
Okay.
don't.
And but
And they don't on ours either.
so
So
they could not force you to join a sale. You could just keep your 30% no matter who buys it.
We could keep our 30%, yes.
Okay.
I mean, at the end of the day, Spartan, we may be the logical one that they try to consolidate at some point in time. But if they just chose to sell out to one of the other players in the area or a new entrant, we could keep our interest and participate alongside. Yes.
Yeah. Okay. Okay. Good. Um, yeah, one concern I would have, like, if let's say somebody with a deep pockets buys the thing and just goes crazy drilling it, would you have problem keeping up? Maybe.
So the beauty of the bank line versus term debt is that you can draw it down and then you can, pay it back.
Yeah.
So, the reason that these 7 wells got drilled this year, in the first quarter or first four
Yeah.
months of the year and got completed in the spring is because if you actually look at the freshwater runoff from snowmelt in the
Oh.
province, it's an order of magnitude greater in kind of end of April, May, June, July, like May, June. By July and August, it starts to dry up. So you've got this period in the spring where you have a tremendous amount of water available
Oh.
for if you build these big ponds and dugouts and you fill them up in the spring, then you frack your wells right away, then you bring them on. So I think if you go and say, okay, I want to drill 25 wells in August, you may be challenged to get the
Mhm.
water to complete those wells.
Oh, okay.
So I mean, Baytex has their own infrastructure. Vest on the other side of the reefs has their own infrastructure. Paramount has their own infrastructure. Spartan's building the infrastructure. I mean, we all have our own infrastructure to do a certain amount of drilling, but it's not infinite. So I think where we're coming from, and the reason that we've got this 16 well program is because that's, closing in on, 750,000 barrel cubic meters of water. And if you see the shape of those curves, you can see what we're doing. We're basically drilling the wells in the first 4 months of the year, and we're completing them in the second 4 months of the year. And we're doing that every year, and we're not doing off-cycle drilling. So, and it's all associated with you're going to have your best economics. Even though it's more expensive to kind of operate in the spring when things are a little bit mucky, it's the best time to get your water
Yeah.
most cost effectively with the best social license. So if someone else comes in and buys Spartan Delta, I don't think they're going to have the social license to all of a sudden triple or quadruple the size of the program. And as we get further into this program, we'll have the resources, we'll have the cash flow to
Right.
kind of keep up. So I'm not worried about this in next year. I'm not worried about it the year after, but 2 to 3 years down the road, we should have the cash flow to basically keep up. And the rest of our business suffers, but remember that's only declining at 13% a year. And you've got a really long life base on which to grow. So I mean, we
Yeah.
don't lose a lot if we don't spend money on those other pools. We don't have anything expiring. We can just spend the money when we have it later on. So I also think the Spartan's quite aggressive. I mean, they're a very
Yeah, they are.
aggressive company, and anyone who knows them and knows the history knows how aggressive they are. And I think there's a pretty good probability that if anyone else acquires them, they will be even less aggressive. So uh,
Yeah.
I'm not worried with being able to keep up, but
Well,
I think and that's a nice to have.
yeah. Plus, Spartan Delta. for you guys on the thing, they're really a gas play. They're by 85% of their production is natural gas and NGLs. So if like the second half of this year, natural gas prices would go up, NGL prices would go up, they felt like it was a good time to sell. If they sold anything, I think they would sell their gas assets. And if let's say then they turn real bullish on this project, then they use that cash to accelerate the growth of the Duvernay, maybe. I
Yeah.
don't know. That would make more sense to me because they're really kind of a really gassy company at this point.
Well, and they're obviously doing this to try and gain, oil weighting
Yeah, right. Yeah.
and gain netbacks associated with oil because AECO gas has not really been kind to all of us here in Alberta in
Yeah.
recent years. Now, if the AECO gas picture changes, they also have a lot of conventional liquid-rich gas projects that they can basically pivot to and spend some money doing that as well. So if you have a year where oil prices are low, like $50 a barrel, do you really want to be drilling these wells and bringing on stuff that's going to produce 100,000 barrels in a few months, and you want to do it at $50 a barrel, or do you want to just pivot
Yeah.
to your gas projects at $4 eco? So I think that we don't really know what the future holds, but we see our bank line as ultimately maybe turning into an RBL from the current sort of 3 tranche system. And we see that RBL maybe growing over time with incremental Duvernay drilling and success of the play. So we see our RBL helping us basically accelerate so we can spend the money on the RBL in the first half of the year and then pay it back in the second half of the year.
Yeah.
So as long as we maintain our discipline and focus, I think we're going to be able to keep up with whoever's operating this play.
Yeah, and see, we're one of our best investments has been Hemisphere Energy. So we understand how polymer floods can really help.
We
And
have exactly that project stuck
yeah,
inside Journey. So you sit there and you think about it, like we have a hemisphere inside Journey. We have a
right.
power business inside Journey. And now we have this Duvernay inside Journey. I mean,
Yeah.
clearly we think the Duvernay is the biggest piece, but that little hemisphere piece is not, is
Yeah.
not insignificant. And the reality is we have not flooded this whole field with polymer because Enerplus had it. Enerplus didn't even move the polymer. They should have moved it in 2020. We started moving it at the end of last year, and we're already starting to see some response. So at the end of the day, I mean, it was just something that they had these facilities there. They built them all, but then they decided they're ultimately going to sell the field. And basically, they went through a multi-year sale process where they emphasized their own resource plays and de-emphasized this and undercapitalized it. So
Well, as you
we're
know,
in a
as you
great
prove,
position.
yeah, I mean, Hemisphere's production, oil production went up in the first quarter from fourth quarter, and they didn't complete a single new well, not a single one.
Correct.
It was all from the reaction, the working of the polymer flood, and that's
Yes.
I see Medicine Hat as a big, nice catalyst for you guys because as it's proven to the reserve engineers that it works, they'll move a lot of reserves into PDP then.
100%. They already moved some reserves for
Yeah,
the
and
new
that's
polymer
a
patterns that we put on last year.
yeah, and those reserve ads can be added year after year after year
Yeah,
too.
at literally sub $1 a barrel.
Yeah,
Like the incremental cost of putting wells on polymer is low. Now there'll be more than that as you over time capitalize the polymer because we capitalize polymer. So that's 3 to 4 million a year or whatever. But initially, just to add some pipelines and convert some water injectors to polymer injectors, the costs are very low, and you can add reserves at tremendous value. And,
yeah.
and
We
but
when I
it's a
was
longer life project.
yeah,
So
they're
when you
long life
look
projects.
at the ability to generate free cash flow with a field like Medicine Hat, and to take that free cash flow and plow it into something like the Duvernay, I mean, there's very few companies that have that, especially companies that have like a $90 million market cap.
Yeah, I tell you, when I went to work for Hess, our tertiary recovery projects, they were fantastic. We had CO2 floods out in West Texas, and they ramped up. Once they start ramping up, they just kept ramping up, and it
Yeah.
was incredible. And that cash flow was used to really the growth of Hess was all funded by a lot of our CO2 floods.
Exactly.
Let me get, I got a couple questions from Harry, and he's very interested in company. He's modeling it for sure. Harry follows 85 companies, so I don't know how the hell he keeps up with them all, but he got 85 companies in the database. I can't even imagine. He says, will all the future CapEx go to the Duvernay with the better economic? Will the conventional go into natural decline, or will you keep your facilities for conventional full? And if the conventionals will decline, what is the conventional decline rate?
It's a really great question, because the reality is these and this is why we sort of talk about rationalizing assets, right? So we may wind up giving up some PV value. We may wind up giving up a little bit of cash flow. We may wind up giving up a significant amount of ARO over the next 2 to 3 to 4 years to get a little bit leaner, and keeping the med hats, keeping the skiffs, keeping the properties that we're going to capitalize. Because this becomes the challenge of, like, if you give me $70 to $90 oil, and I know that you say that you think oil is going to be back in that $70 to $85 range. Well, with that kind of thing, I think you almost have the ability to do everything. But with $60 oil, right now, all of our capital this year, other than going into the power business, because you're in the middle of this regulatory process, you have to finish that off. So once that's finished off, there's no more capital going in there. Next year, I would say that all of our capital again is going to go into the Duvernay. Why? Because we have to chase around Spartan. So we're not going to go penalty on a well, and so we can do some additional drilling in Medicine Hat or Skiff. We're just going to dedicate the capital to there. But at some point, you've got a bunch of facilities that are underutilized, and you can add huge value at low operating costs if you just put some capital into your base business. So the capital into the base business is going to have the same economics as the Duvernay capital. It's just going to have lower rate, longer life. It's going to be great capital to employ. Arguably, we're going to need to start spending money on that, but I would say, because our decline is so low, it's not like our decline's 30% and we're in some kind of death spiral on that. There's been years where we haven't drilled a well. 2021 was a perfect year where we maintained our production, didn't really drill a well. We're not drilling a well in our business outside of the Duvernay this year. We'll see how that production fares. It'll fare better than you think. The reality is we do want to drill wells and capitalize our base business. So we may wind up rationalizing parts of our base business that we cannot capitalize just because there's just too much. But we're definitely going to spend money in Med Hat. We're definitely going to spend money in Skiff. But I would suggest that's probably not happening until 2027.
Okay, Harry said, and he really likes Spartan Delta, by the way. He expects recovery per well to be up in the 600 to 1,000 or 600,000 to 1 million BOE per well.
We've got 750,000 in our type curve that's up there. Yeah.
Oh, okay. Okay, so you're within that range.
Yeah.
Okay, similar covered. Your latest 2025 CapEx outlook is 55 million Canadian. Do you expect future CapEx to stay in that level? Do you expect this to go up with more Duvernay drilling? And I think,
yeah, so next year I'd say that, we'd be looking at somewhere in the neighborhood of 75 million of capital, 60 million of going to the Duvernay. And I would say that, you'd be looking at production kind of in that 12,000 barrel a day range. Your liquids, again, picking up to maybe 62 to 64% liquids. You're bringing on additional production in the Duvernay. So yeah, your capital's going to go up, and then the year after that, it may go up again based on availability of capital. It's all going to depend on price.
Okay, and we're getting near the end, but I'll just close here by saying I spoke at that conference up in on May 21st, and there's a lot of industry people there, and they all think that the oil price is just artificially low. There's so much uncertainty, with this tariff thing, and what the hell's going on with OPEC Plus and them wanting to raise their production quotas, which is not physical increase, really. They're having some internal issues within OPEC right now. So if we could just get past that noise, and then of course you got the situation with Iran out there, what the hell's going to happen there hanging. So there's a lot of things we know, but I will tell you, I follow a lot of these pretty large companies, Diamondback, EOG, Coterra, and that, and they're pulling back on their capex. I think what they're going to do, if they keep drilling wells, they're going to just put them in duck inventory, some of them,
Yeah,
because it's just stupid. Like you said, why do you want to complete these high rate wells that come on really high, produce in the first year, maybe 50% of their recoverable oil could be recovered in the first year, 18 months. You don't want to complete them in a low price environment. Why? So I think you're going to see, I think U.S. oil production by the end of the year might be 400,000 or 500,000 barrels a day lower. And if you ask me, EIA and IEA both they're too optimistic about non-OPEC plus production increases. I don't think it's going to keep going up like it has been going up. So it's going to tighten. There's no glut. I showed one slide at the end, and I said the amount of money that is invested in the energy sector, publicly traded, it's at or below the amount of money that was in the energy sector at the height of COVID. In
for sure.
2020 and 2021, there was more. And think about that. Oil got down to like $13 or $14 and hung around, didn't get back to 40 for a long time. And there was more money. And the gas price was low. The gas price was real low then too. So I think there's more economic good with the gas price going up, NGL prices firming up. I think this is a great time to be finding, well capitalized small caps that got a good story that, if you report those like 5 or 6 wells coming on really strong here in the next few months, that could draw a lot of interest to the company. We saw that one of our little companies we follow is Calibre, it is listed on TSX, but they completed 3 wells in the fourth quarter last year that came on like double what the type curve was. Oh, and the stock price just jumped, because it doesn't have many shares. And that's another thing for you guys. You have relatively few amount of shares.
Yes.
A lot of the juniors have 300,000-400,000 shares outstanding. So so on a per share basis, this Duvernay thing could add on a per share basis quite a bit to your net asset
Yeah,
value.
I mean, it could easily add, $6 or more
Yeah.
per share.
Yeah, and there's no company that's, has a stable balance sheet, isn't in any near-term debt problem, and has this kind of running room should not be trading below book value. And you're not alone. I'm telling you, there's a lot.
No, we're not alone,
Yeah,
and we do think that the problem is that nobody cares about
yeah,
book value. The
yeah,
only thing they care about now in a declining or low price environment is your cash flow and your ability to grow that business using your cash flow. And, cash flow, free cash flow, you name it. And so we think nobody cares about net asset value. But as the commodity price turns and starts to go forward and starts to go up, if there's a view to commodity prices going up, and that was the view coming
yeah.
out of 2020, is that commodity prices were going up. In that environment, you want to own something with a lot of barrels under management. And then you stop focusing solely on cash flow and solely on operating income, and you start to look at the underlying value of the asset base over time. And so if we can have catalysts in the Duvernay, rising cash flow, and this stable base and big value at the same time that commodity prices are going up, then I think the value journey story can change very dramatically and very
Well,
quickly.
so we kind of had a panel discussion up there in Dallas a couple of weeks ago of industry people and stuff. So, and we all said, okay, can, all these predictions, like you got Goldman Sachs or somebody saying oil's going to go to 50 and stay there for a while. And we're all kind of just shaking our head like the supply demand fundamentals don't push to that at all.
Right.
Not at all. So, we don't have a glut of it. Remember in COVID, we ended up with a big glut of oil in storage. I mean, storage was filling up. And so you had to work off that glut. But we're
Right.
sitting here today with US and OECD inventories below normal. Our diesel, and let me tell you something about Canada. We need that heavy oil.
Right.
Yeah,
And it's difficult to pick the bottom too, right? I mean, you can
yeah,
never pick the very,
never picked the
yeah,
bottom,
maybe
but
oil will go down at 50 and maybe you'll be able to get journey 10 or 15 cents cheaper. but maybe it won't happen, and maybe we'll announce these wells and oil will
Yeah.
go down, but the stock will go up.
Yeah.
So you really don't have, it's hard to pick the bottom.
Yeah. And I can tell you, if oil would drop to 50, you would see a lot of drilling programs. The brakes would be slammed on at 50 and it would rebalance very quick. It's actually, if the lower it goes, the bigger the rebound will be, which
Well, and
is,
we saw that in 2022,
I
right?
know,
Coming out of
2022.
COVID, we saw that
It went to 80, it
giant
went to
local
87.
high. And
Yeah. Yeah.
geez,
The,
if we get one of those in 2026, at the same time we're bringing on 16 Duvernay wells, you can imagine what
yeah. Yeah.
momentum
Look
we
at
can
you, bring
build.
up a 5, 6, 7 year chart of oil, and you see that from the bottom of the COVID thing, when it was really, really demand was the biggest decline in demand ever.
Yeah.
In the real world, it dropped to like $13, $14, but it was up to 60. WTI went up to $87 per barrel before Russia invaded Ukraine, and then of
Yep.
course it went to like 120. And you still got that situation. This situation in Russia, you can tell Putin is not. He doesn't seem in any hurry to get a
Nope.
peace deal. He'll fight to the last soldier's dead or something. I don't know, but it's crazy. And so I don't see that. So if they start slamming more, restrictions, sanctions or something on Russia, that could affect it. There's just so much noise. I cannot remember a time when there's been this much noise with all these different things going on that are just, like they said, it's just a period of uncertainty that nobody knows what. And in the same thing that I saw the other day, it said, we also need Canadian steel and we need Canadian aluminum.
Yeah.
I think if your prime minister up there, sits down with them and says, hey, look, no tariffs on oil, gas, steel, and aluminum. We can work out a base tariff of 10% for everything else. I think that could solve this whole, get rid of that fear, because we need
Well, the
this.
worst thing you want to do when oil prices are under pressure at your own hand is to increase the cost of all of the.
Well, it's like, they're real bullish on all these AI data centers. Well, guess what? If your steel costs and what are AI data centers made out of? Steel and aluminum, and so are LNG export facilities. So they're real bullish on those two things. Well, you can't ramp up steel and aluminum costs because that'll make the economics not work on those facilities. But it's going to be, this is a real interesting time, but it's going to
It
get,
has to work itself out in the end.
yeah, and it always does. Fundamentals always win out in the end. So
We just need to be
anyway,
positioned for when it does.
yeah, thanks a lot, Alex. We'll keep in touch, and we're definitely watching this one very carefully. And you're going to stay in our small cap growth portfolio, that's for sure. All right,
Thanks
man.
for everything you do, Dan. I really
Yeah.
appreciate the opportunity to do
Okay.
this.
All right, we'll have to get you down here sometime to do a Rock Resources. Actually, on June the 19th, we're having Rock Resources guys come down, and they've paid off all their debt.
Yeah.
Yeah, they're debt free now, and it's a smart move. Anyway, okay, thanks a lot.
All right,
And
take care. Thank you so much.
okay, Sabrina, you can end it there. We're gonna we recorded it. We'll be sending out the recording, which is going to get a lot more eyeballs this afternoon. All right.
Really appreciate it.
All right. Thanks a lot.
Thank you.